Good morning and welcome to our CFC Green Room on battery storage. My name's Monique Miller and I'm the Chief Investment Officer at the CEFC, responsible for the teams in our business that invest in renewables and battery storage as well as debt markets. We've brought together today three panellists who will tell the story about the birth and the early years of utility scale battery storage in Australia from their own hands-on experience. But first, I would like to acknowledge a group of people who, of course, are the original storytellers in this country and the keepers of wisdom and learning about land across Australia, including land on which these battery projects are being built. Where I am, here in the Sydney CBD, I would like to acknowledge the traditional custodians of the land, the Gadigal people of the Eora Nation, and pay my respects to their elders, past and present. And on behalf of the CEFC and the panel, I would like to extend that respect to all Aboriginal people. In terms of a much smaller story, we have an hour together now as a panel to chat and deliver some of our learnings in this green room. I'm delighted that we've had such interest from the community in energy and investment. We've had over 800 registrations and a great diversity of backgrounds for people that are joining us today, from engineers to developers to firefighters to lawyers, banks and governments. I'm feeling slightly intimidated, but also hopeful that you'll each learn at least one thing during this session. So, as an investor in over 40 renewables and storage projects and having supported over 5 gigawatts of renewables in Australia over the last decade, CFC can confirm that the past few years have been particularly challenging for the industry. We've seen growing ambition from state and Commonwealth governments, but at the same time, we've had supply chain constraints and meaningful increases in capital costs and interest rates. Investment in wind and solar has slowed in the past year, but utility scale batteries have been the outlier and have exceeded all past expectations in terms of their contribution to the energy mix. Our panel should be able to help shed some light on why that is. But first, to help set the scene, I wanted to provide a few slides visually to show how quickly this battery storage story has evolved. So on this first slide, as most of you know, the Australian Energy Market Operator, or AEMO, has the challenging tasks of managing our energy markets and keeping the lights on. This task is increasingly complex as our coal-fired power fleet ages and is likely being replaced by a combination of renewables, storage of different forms and gas. We're moving effectively from a grid powered by spinning turbines near the cities to a grid powered by variable solar and wind resources and inverter-based technologies. So to help give an understanding of what the engineering and investment task might be in coming years, every 2 years, AEMO publishes what is known as the Integrated System Plan, or ISP, for the East Coast electricity market. Very simplistically, this is AEMO's hand-on-heart modelling scenario of what the most cost-effective generation and transmission build would be in the coming decades, given the known policy settings, and projected cost inputs. There are very many complicated factors, local and global, that inform this scenario. So, of course, it evolves over time as new information emerges. I just thought it might be useful to look back just a few years at the last few ISP to see how AEMO's view of the role of battery storage in their scenario has evolved. You can see from this chart that back in the COVID lockdown days when the 2020 ISP, which is the black line down the bottom, was being prepared, effectively AEMO's forecast, given the policy settings, construction costs and other inputs at the time, said that the optimal energy mix would barely involve any more battery storage than was already built at the time. Moving up then to the light green line, we saw back in 2022, so only a couple of years ago, the scenario then predicted more battery builds, but settling at a level of under 4 gigawatts by 2030. Of course, since that plan was released, we've seen so many significant investors commit to batteries so that the starting point this year, which is the dark green line, is already about double what was initially predicted. And with the updated inputs for their draft 2024 ISP, AEMO now includes more than 10 times as much utility storage by 2030 than it did less than 5 years ago. So the story's really quickly evolved. And that's not all. So AEMO's ISP, as I've mentioned, is a theoretical scenario and responds to the market and what investors are actually building in the market. So let's look to what we're actually seeing. The green bars on the chart show the new build that the ISP for 2024, so the most recent one forecast, which is what I showed on the last chart. The dotted line above shows what we're actually seeing being built in the market only based on publicly announced offtake agreements. So you can see that already the dotted line is well exceeding what AEMO had forecast would be the case, and we expect it to exceed that by quite a significant amount over time. So I think the panel that we've brought together today is really well placed to talk to some of the inputs that are driving that buoyancy of the battery market. Moving to the next slide, as we move to a grid with more variable renewables, we also need to understand not only the capacity of the storage we need, but also how long we might need that storage for under different circumstances. So how many hours of generation, hours, days, weeks might we need in different scenarios? So if you look at the left-hand side of this chart, that's effectively the numbers I showed before about how much capacity is going to be needed under AEMO's scenario to power the Australian grid in storage. So this now includes not only the utility storage that I showed before, but it also includes distributed storage and pumped hydro and other forms of longer duration. And what you can see on the graph of the right there is that although, say, the pumped hydro storage is a small amount relatively of the capacity, it's a very large amount of the megawatt hours of storage available. So what AEMO is telling us, I think, is that there are some pumped hydro projects that will provide significantly long duration storage requirements, and that there's also a very significant amount of heavy lifting that would optimally be done by behind the meter household and business batteries. The challenge, of course, for this longer duration storage is that there isn't currently a revenue signal in the Australian energy markets to value that insurance-based deep storage capacity. So that's something that may change over time, and those sort of price signals will be needed to unlock that type of new build that is required by the market. All right, so enough of the charts and enough of my talking. Let's get back to the panel and their learnings and stories. I'd like to introduce our panelists. These are people who, alongside the CEFC, have been right in the thick of working out how to build, connect and invest in larger and larger batteries in Australia as our energy mix changes at an unprecedented rate. I think it's fair to say we've all been learning by doing, and I think some of the learnings from our panel today will be really valuable to me and to this audience. Thank you very much for joining us today. I'm hoping to be able to have a fun and challenging conversation despite the challenges of joining each other online rather than in the room. I have a few questions to kick off the discussion, and I'd also like to encourage our audience to submit their own questions through the webinar. You should be able to see a Q&A box on your screen, and please feel free to submit your questions there. We will do our best to navigate the technology and select a few which we think might be of interest to the larger audience. We won't get to them all, but I will review them afterwards and share any themes with the panel for future reference. One bit of housekeeping, we will be recording the webinar, so please feel free to go back and watch it or to share it with your colleagues afterwards. And once the webinar ends, you'll see a short survey pop up on your screen. I'd be grateful if you could fill it in. So I'd like to now introduce each of our panel members. So Joseph Tadic is the Regional Director Energy for APAC at Tesla. Hi, Joseph. Joseph leads Tesla Energy's team across APAC and is as well the Director of Tesla Motors Australia. Joseph has over 20 years experience in the renewable energy industry. He joined Tesla in 2015 to lead the APAC engineering team for residential and utility scale storage and EV charging infrastructure. To Joseph, below Joseph on my screen is Nick Carter. Nick is the CEO and Managing Director of Akaysha Energy. Nick was motivated to found Akaysha Energy after not only seeing gaps in the market for a fully integrated development business focused primarily on innovative and rapid deployment of battery storage systems, but also seeing the opportunity created by the huge renewable energy transition in Australia, across Asia, and more widely. Hi, Nick. Finally, Tony Ong is the Chief Financial Officer at Neoen Australia. Tony's been involved in the financing of renewable energy assets since 2010, closing over 3.5 billion Aussie of project finance debt to fund more than 3 gigawatts of wind, solar and storage assets, including, relevantly for this panel, a gigawatt of batteries. Hi, Tony.
Hi, Monique.
So, Tony, actually, I might direct my first question to you. Neoen and Tesla were right in the thick of Australia's first very big battery, the Hornsdale Power Reserve. This was famously conceived and built in record time in response to a South Australian call for market for technologies after grid outages in that state. Neoen owns the battery, which was manufactured and built by Tesla. Can you share with us a bit about what that experience was like for Neoen and some of the learnings?
Yeah, sure. So, look, a lot's been written on the 100 days or it's free promise, so I won't repeat that story. But from Neoen's perspective, it suddenly required very, very close collaboration with Tesla and our other partners from start to finish. In fact, a few Neoen people were even working out of the Tesla offices in the early days. What Neoen and Tesla have always shared together is a spirit of innovation and audacity, and the discipline to focus on our own strengths, which happens to complement each other very well. Electronet was also instrumental in helping us meet the 100 days timeline, connecting the battery in record time. Sadly, one of the delays we see in the development of new batteries today is that the connection application process that took us 100 days or less in 2017 can today take 300 or 400 days just due to additional requirements, which is sometimes more bureaucracy than engineering. But in terms of our experience developing and operating HPR, it certainly taught us some valuable lessons. So firstly, it's important to be agile in our decision making. Batteries need to be developed very, very quickly, and there's a huge benefit to being the first mover. We were the first to develop the big battery in South Australia and later in Victoria and now in Western Australia. And now each of those batteries has contracts providing grid services either to AEMO or the state government. And each benefited from limited competition in the early years. And in each, we work with very credible partners with experience who we trust to deliver those projects quickly. Secondly, we develop batteries where it serves the network best. This puts us in a strong position to secure contracts providing those grid services. And sometimes we've provided grid services for which there's no market and we don't get paid for it, but we think that over time that providing essential grid services will make sense commercially. And thirdly, we make strategic investments by oversizing connection infrastructure even before there's an obvious business case to do so, in preparation for future expansion. So this was the case for HPR because we had already built the Hornsdale wind farm nearby, and we had oversized the connection there. And it's the same thing now with Western Downs Battery, which is co-located with Western Downs Solar Farm. And similarly, we built Cully Stage 1, and we've just announced Cully Stage 2. All of this has shared infrastructure.
Thanks very much, Tony. So lots of learnings from the early market, which you've been able to apply to Neoen's benefit more recently. So I guess following on from that, a question for Nick. You're currently building the Waratah super battery also under a compressed timeline and in a challenging supply chain environment. Can you tell us a bit about that battery and what learnings did you take on board from early battery experiences, including the types of things Tony's talked about, and what have you learned in the early parts of the build?
Thanks, Monique, and firstly, thank you and the CEFC for hosting us today. It's a real pleasure to be here. So obviously from some of the early projects, there's a lot of learnings that were taken away, which are kind of amplified for something as big as Waratah. And for those in the audience who aren't fully aware, the Waratah battery is an 850 megawatt, 1.7 gigawatt hour system. So it's pretty large, and that obviously creates unique challenges which you just don't see on smaller systems. So some of the things that we've learned and leveraged previous experience on are things like the layout and the design, which is really important for constructability. And we're seeing that in real time at the site is you just can't physically install that much equipment quickly unless you actually design for it, which means spacing and things like that were really critical to how the battery layout looks. And also service. So it sounds weird, but it's actually partially designed in terms of its layout for serviceability as well. It's actually super important. You can effectively paint yourself into a corner with such a large project with only a given amount of space. So that's been really important, and learnings from previous projects. Probably the other big one is, which again, you wouldn't necessarily think about when you first turn your mind to a very large system, but it's designed for redundancy. So because the system's so massive, you just can't have a single point of failure, because that's just uncommercial, unbankable, uninvestable scenario. So a heap of work went into the Waratah battery just on the HV and MV design, and in order to make that whole side of the system as robust as possible, especially given the SIPS contract that the battery has as well. It's just in terms of being able to always guarantee that it can provide the service. And then some of the other things which I think both Tony and Joseph know well, project, for example, are just things like parallel construction and parallel commissioning. So you really need to be effectively building one side of the system while the other side's getting commissioned, and you can basically walk through each block and see the evolution, almost like a car production line. And that's something that obviously Tesla and Neoen pioneered on the Hornsdale battery early on. So it's a very similar kind of construction methodology for that. Logistics is really hard. You can imagine, just with so much physical equipment, actually getting it there is hard, and manoeuvring it around the site, storing it, holding areas for different parts of equipment. Logistically, it's really super challenging on that scale. And then probably the last couple of things are really around the supply chain. Just with a 1.7 gigawatt hour system, kind of just rolls off the tongue. But even some of the biggest suppliers, really struggle to necessarily deliver all of those battery cells in one hit. And as a result, you potentially end up, in our scenario, with multiple suppliers, multiple factories, all making the same equipment around the world, which again is a bit of a diversity play as well, is having, 2 or 3 factories making the same PCS in different places around the world with different supply chains is actually beneficial, but it also means it's really, really hard to coordinate logistically and commercially. So they're probably the key things that we've learnt from previous projects and the current Waratah project.
Thanks very much, Nick. So I'm sure Joseph over time will have some thoughts about the manufacturing challenges as well. But before that, Tesla's been an early mover in utility batteries in Australia, as we've mentioned, as well as, of course, the household battery and the EV space. Can you tell us a bit about, elaborate a bit more on Tony's points about the grid support capabilities that Tesla's been able to prove from its fleet of batteries, and how have the batteries performed when there's unexpected grid events happen?
Yeah, and thanks, Monique. Firstly, thanks for all your leadership of the CFC over the years. I don't think we'd be having this forum without the CFC, to be honest. So thank you, and it's great to be part of this forum. So although I know nowadays large-scale battery storage is kind of accepted as a viable technology, back in 2016 when really what spurred this was the SA blackout, that wasn't the consensus wisdom at the time. So I think there was a lot of skepticism, not just in Australia, but globally on if batteries could scale to transmission scale. Because up until then, it was really globally, the transmission applications were relatively small. They were mainly distribution level connections and pilots. So I think what we learned through the Hornsdale experience and being at the time the lead designer on Hornsdale was a very dynamic process to go through. But what we did learn was that batteries are incredibly fast and incredibly flexible and can integrate very quickly into a scheduled generator, which in the NEM and in the Swiss is following a dispatch signal. And I think we proved that to market operators in Australia and also globally that batteries follow dispatch super quickly. In fact, in the early days, it was actually following a little bit too quickly. So we had to actually slow down some of the response following the 4-second AGC signal, which is what controls a lot of the scheduled generation in the NEM. What we also found out was for frequency control, the batteries also are super flexible and operate quickly, and that is really fundamental. A fundamental issue there is the speed of response of inverter-based control systems. They operate incredibly quickly, usually in a couple hundred milliseconds, responding to local frequency deviations. I think that was a big learning in Hornsdale, and I think there's a lot of publications on that, which are all public information now. We then, as Tony was alluding to, Hornsdale was an early mover, early success, a great application for the industry, not only in Australia but globally. Went very quickly to the expansion, so we expanded that from 100 megawatts to 150 megawatts, and as part of that, we also rolled out the grid forming inverter technology. So all of the inverters actually have that capability, but initially we had it in grid following, but demonstrating then the grid forming capability of those inverters was also a key learning in learning how the renewable future will eventuate in terms of replacing some of those system strength benefits which were taken for granted in that synchronous fleet, which the power system's been designed around for the last 120 years plus, right? And so that was also a large learning. And what we found now is majority of our projects now are just a grid forming from the start. We've skipped that kind of grid following technology chain. So yeah, there's a few learnings over the last 8 or 9 years or so, which have been pretty exciting in terms of the power system.
Thanks, Joseph. So over to you, Tony. We're having some questions coming in about the more the financing aspects. So we've touched on the last questions a little bit about the technical aspects of what batteries can offer. Back in 2020, I think your team and my team worked together to build a debt financing product that tried to accommodate some of the different and unique battery revenue streams. I'm interested in your observations on since then on what's happening in both the debt and the equity markets in terms of understanding and investing in those revenue streams. If you could perhaps provide us a bit of insight on that.
Yeah, sure. Thanks, Monique. So look, I think as we talked about before, like we've got 1.6 gigawatts of batteries in Australia across 8 projects. Of these, 1 gigawatt has already been project financed, and the balance will be financed later this year. So when we built HPR in 2017, it was financed without any bank debt. The majority of the revenues were merchant, and so there weren't available consultant forecasts for those revenue streams at the time. So it was just impossible to get project finance debt. Our second battery was a 20 megawatt Tesla battery co-located and financed with the 200 megawatt Bulgana wind farm in 2018. And at the time, we financed the wind farm, and the battery just kind of came with it. And the lender said, "Well, we're not going to give you any credit for any of the battery revenue," and all of the debt was sized from the wind farm only. When we expanded HPR, as Joseph just alluded to, in 2019, it gave us the opportunity to talk to the CEFC. We had 2 contracts with the state government by then. Aurora had also entered the market, providing third-party forecasts for arbitrage and FCAS. So, and we had a proven record of operations and participating in those markets. Commercial banks were still not open to financing it at the time, but as you mentioned, Monique, we had the fortune of being able to talk to the CEFC and creating a bespoke product together that had revenue sharing features in order to size debt from the merchant cash flows. And over the 3 years after that, from 2020 to 2023, we spoke to various commercial banks trying to convince them that this was a structure that could work for them as well. But I think for the most part, the appetite was not there. And up until recently, the focus was more on batteries with full tolling agreements. In the last 18 months, there's been a lot more appetite from commercial banks, including for merchant exposure. So in January this year, we reached financial close on our first baseload financing, which included a baseload offtake agreement supplying firm power to BHP's Olympic Dam, supported by our Goyder wind farm and the Blythe battery. Of course, we had the critical support of CEFC there, but also we had 4 local and international commercial banks participate. And I also read recently that Akaysha has closed a battery financing in the past week. So perhaps Nick can share a bit about that in a second. But look, in the meantime, we've seen a trend towards large portfolio financings in the renewable market as well, more generally. And so we think this is a source of competitive advantage as well. We closed our portfolio of 8 wind storage and solar assets earlier this year, and with the diversity of technologies, states and revenue streams, we think lenders are a lot more comfortable with the inherent volatility of merchant battery cash flows, which can all be managed within that structure. And then coming to the equity side, we're definitely seeing a lot more competition now than ever. In the first year or two after we invested in HPR, there was a lot of talk, but not yet a lot of proof that the market worked. And so it's only in recent times that we've seen a lot of new developers popping up into the market. Similar, it reminds me a little bit of the solar market in 2016-17, and hopefully we don't follow that example and have inexperienced developers make foolish investment decisions. But I am a bit concerned today if there are developers expecting very high returns based on optimistic revenue forecasts, which rely on historic FCAS levels. For us, our projects tend to have multiple revenue streams, both contracted and merchant, and we try to unlock the value in firming. We're trying to build a balanced portfolio because we think that the value of storage is maximized with generation.
Thanks very much, Tony. I think your thoughts resonate with me as well, and it's really inspiring for us actually to see the private sector banking community particularly really leaning in and trying to grapple with what this revenue mix looks like. So you've spoken about a couple of different contracting models. Nick, I might throw to you both for your views on the appetite in the market, but also the capacity investment scheme. So that's a huge policy step in the Australian environment to deliver storage and renewables, and your Arana battery was one of the first to receive the CIS contract under the early tenders. What opportunities do you think the CIS represents for more traditional investors in battery storage that might require more of a contracted model than a merchant model?
Yeah, thanks, Monique. Maybe firstly, just on the points that Tony was making around debt. I think people may have seen the 250 mil debt package that we closed on a portfolio of batteries. And I think that's interesting because it's partially merchant and partially contracted. So it does go to this point as well. Also noting Tony's concerns and comments around people banking, historical data. Obviously, at Akaysha, like most sophisticated developers, we've got in-house views and modelling and dispatch optimization in order to make sense of that. And that's actually a good segue into your questions around the CIS. At Akaysha, we really think the CIS has been great for us in terms of really getting that first 4-hour battery away, which is the Arana project, which is a very large 4-hour in New South Wales. Without the CIS, it would have been quite hard to get that off the ground, mainly because the 4-hour revenues compared to, say, a 2-hour are still, how would you say, immature to the market, not necessarily immature to the people that are modelling them and looking at the benefits of a 4-hour, but the market generally just wasn't quite there in terms of valuing it, which is where the CIS really helped us move that along. I mean, the other thing about it is that the tenor, so 15-year tenor is, actually pretty attractive when you look at capacity contracts around the world. There are places in the world where they have 20-year contracts, etc. Others have 5 or 7 or 10. So 15 is actually pretty good. That makes a pretty big difference to financing of it, and really good for our investors as well into that project. I think probably the key piece here, and I know that Joseph and others have got also quite a bit to add into this topic, is why we really like the CIS and the way that it's structured is its flexibility. And what I mean by that is it doesn't by its nature, it doesn't necessarily impact how you operate the battery. So you still go and chase, the most revenue you can get out of the battery, but you've still got the floor sitting there of the CIS, and that's a really powerful tool, because it really allows you to potentially continue to operate it to maximize revenue, which in theory should be the biggest benefit to the NEM and consumers. And it allows you to potentially layer other contracts or other offtake on top. So we really see that the CIS is great for doing that, which means it does support the liquidity of the OTC market for storage without kind of cannibalizing it in that sense. So it's a really it's walking a nice tightrope between sort of consuming OTC volume with respect to offtake, and at the same time allowing you to run the battery to maximize revenue and benefit the NEM in that way. So yeah, that's probably the summary. We really like the flexibility of this particular scheme, and we're hoping that there's more into the future.
Thanks, Nick. Yeah, I think casting back to your comment about 4 hours being more difficult as that kind of arbitrage value reduces, and obviously that problem is exacerbated for even longer duration. What I do like about the CIS as well is that kind of future proofing, because it's a revenue floor based scheme. If there were other markets evolve over time, whether capacity market or other grid services that Tony mentioned were currently unpaid but are valuable, then there's no kind of conflict between either party's interests under that CIS and a future regulatory regime that might bring forward the next decades of storage activities. So that's one thing I like about it as well. Joseph or Tony, did you have anything else you'd like to add about the CIS and how you're trying to absorb that into your business models?
I might just add just on the CIS. I think it's a well-needed step for industry, right? And one of the great things which I think this panel's highlighted is it's the bundled revenue. So it's the FCAS markets, and the FCAS markets are complicated and they're shallow and they jump around a lot. And there's 10 FCAS markets now, right? Plus an energy market. All of those need to be co-optimized. And since the early days of privatization of the NEM, the FCAS markets weren't really ever designed, in my opinion, to drive investment, but it was more driven to co-optimize the energy and FCAS of a traditional thermal generator. And we're now in a power system where the thermal generation is coming off, and we're replacing that with new technologies and new flexibilities. So the NEM really designed from an energy only back in the early days is now evolving, and that CIS is a critical bridge, in my opinion, to moving forward to future market designs, because the power mix is completely different to what the teams back in the late 90s thought the power system was going to be in 25, 30 years, right? So.
Thanks. Tony, did you want to add anything to that?
I was just going to say that, look, it's definitely generally a step forward. We're hopeful to have some projects selected as part of the CIS soon as well.
So then I guess stepping away from the local and moving more to the global, a question back to you, Joseph. I was lucky enough to be able to visit the opening of the Tesla Mega Factory in the States, and I was struck a bit by how much front of mind that kind of Australian early stage Hornsdale story was in the kind of the global Tesla story about battery utility storage. Can you comment a bit about how Australia is placed on our journey with utility batteries versus what Tesla's seeing in the rest of the world? And are there any learnings from this end that are being going out to on a more global basis by Tesla?
Yeah, that's a great question, Monique. And I remember hosting at the Lathrop factory. It was a fantastic event. So I think Australia's definitely been and for a variety of interesting reasons, been at the forefront of the battery expansion in globally, right? So back in really 2016 is when it really kind of all started off, and we were doing smaller, like 20 megawatt kind of projects in the US with SC&E and PGE in the West Coast as they went through their mandated 4-hour battery targets. Then Hornsdale at 100 megawatts was kind of really demonstrated that, yes, it could work. So a lot of those learnings, both on a technology level, so like physically, how do you coordinate that number of inverters at a site to follow a dispatch, and how do you coordinate that number of batteries such that you're balancing the state of charge as it moves up and down? All those lessons were really pivotal in developing our product, and we moved from basically in the Hornsdale days roughly a 500 kilowatt unit to now a 2 megawatt individual unit, right? And so that all has been around scaling, and that has also resulted in reducing the price because global supply chains have ramped up. Lessons have learned, innovations come through, which is the way the market works, and we're getting that price point pressure. That price point coming down, and that then is fueling up more implementation globally through. And historically, Australia's production, Tesla's production, but 25 to, depending on the year, 25 to 30, 40% of the global production is going to Australia. That's changing now because of in the US, the IRA and the massive ramp up in storage in the US. But for Australia, a small country of 27 million people, we've been punching above our weight on the global scene. That's for sure.
Thanks, Joseph. It's good to hear that. Hopefully continues. So Tony, we're having there's a general theme about kind of bankability aspects and a bit more about how you think the banks might accommodate a contract like the CIS or a contract with the revenue floor and some upside sharing. Do you have any thoughts based on either early internal considerations within Neoen or feedback from the banks so far?
That's a good question, Monique. We're still having early discussions with a couple of banks, including yours. It's definitely interesting. I mean, clearly it depends on where the different cap levels are set. So the level of merchant, the risk around the merchant will probably be greater than on a standard merchant project. So we've got to take that into account, but we think that there's still going to be material benefits taking into account the level of contracting and merchant as well. But we're still in the early stages of thinking about that.
Yeah, and I suppose maybe one for you, either Joseph or Nick. There's a requirement being floated in the draft CIS around the LOR3 reserving. So effectively, when AEMO sends a signal that there's likely to be a reliability shortfall in the NEM, that there's certain response being sought of the batteries which have a CIS contract. Do you have any thoughts on the practical aspects of that type of requirement being written into an offtake agreement and how that might change behaviour?
Yeah, well, maybe I'll start, and then maybe Tony or Nick, you can jump in. And so just for the context, so LOR3 so we've gone from LOR1, which is we've only got the two biggest generators as buffer, to LOR2, only one generator is the largest generator as buffer, to LOR3, where supply and demand we're at the cusp. So that's when below that, at that point, we should be load shedding to manage any increases in the marginal load, right? So if an offtake on a battery has an LOR3 reserve requirement, effectively, there are, and I know this has been an issue in the CS development, and proponents have put forward questions on how we would actually do it in practice. The question would then be, how is that reserve capacity to be maintained at all times? How is that going to impact the rest of the time when LOR3 is not part of the picture? So, for example, LOR3, if you look at the data, the power system, the LOR3 is designed for only several hours a year. So what are the impacts on the power system and the impact to consumers for the cost of energy through when the rest of the time when we're not in an LOR3 scenario, right? So I think these are all issues which we need to play out, and there's no simple answer to that, in my opinion. All global power systems are going through this. Capacity markets globally go through this issue, which is effectively where we're kind of moving in the NEM. And similarly, we have the similar issues going on in West Australia, the Swiss, which already has an established capacity market. So that's kind of my view on the LOR3 issue. No, Tony.
Yeah,
thanks.
I mean, sorry. We did a bunch. Obviously, this LOR3 topic is rather important with respect to the CIS contract. We did a bunch of, quite deep modelling with respect to LOR3 and how that impacts potentially how you would operate the battery. And at the end of the day, as you're bidding and trading the battery and looking at the market, you have a view of how tight the market is per Joseph's description. And generally, there's really quite good correlation between how you would operate it and an LOR3 scenario or an LOR3 day. So from our perspective, it wasn't a huge leap to kind of join those things together and get comfort around it.
Thanks. That's good. We've had a question come in for the audience, and it's probably one for you, Joseph. It's around, we've been talking a lot about utility scale storage. When we cast back to that AMO ISP, it sees a significant role for consumer energy resources. And I suppose there's a world where part of that is played by vehicle to grid. So we have a bunch of batteries driving around on the road. Is there a role for them to plug in and provide part of that storage need to the grid? Can you maybe talk a little bit about, Tesla's work or thoughts about that, how that part of the storage story might evolve?
Yeah, absolutely. This is an exciting one, and I would comment. Look, the ISP, the architects of the ISP have done an amazing job coming up through it, and you've seen it over the years developing. But one of the interesting things about all forecasts is that all forecasts are wrong. It's just how they're wrong, which is interesting, right? And that's kind of we're learning that as the industry develops. So if we look at the way the CER impacts the energy mix. At the moment, we're expecting this to be quite an increase, definitely an increased impact, but a much larger impact than utility scale storage. What we're finding on the ground in our experience to date has been two things. Firstly, you need to do both. There is no silver bullet. There's no vehicle to grid will do all of this. We need to do everything. We need to do utility scale batteries. We need to do residential batteries. We need to do demand response, traditional demand response, vehicle to grid, vehicle to home, however we want to call it. But the reality is the market incentives are not really present there at the moment to encourage that kind of wide-scale rollout. And there's also some technical market barriers for actually implementing it in practice. So our experience to date is that in terms of purely just based on revenues, like the majority of the investment is going into utility scale storage. We're not seeing that going into the CER. CER is still going at an amazing pace, but utility scale is just driving a lot higher. When we're talking about vehicle to grid, we are seeing definitely an increase in electrification of vehicle transport, which is fantastic. I know we're looking at like 12% plus on new car sales now, which is great. We're going to have a lot of gigawatt hours of storage in terms of on the vehicle fleet physically there, right? So the questions for me and for the market is, we have to recognize two things. Firstly, for CER, the consumer actually owns it, so it has to benefit the consumer, right? It needs to be a rational decision for the consumer to participate in the market, and some people may or may not, depending on how they use their vehicle, the battery want to participate, right? And then there's the question of when do we modulate that charging on a vehicle? So if you drop the charging load on a vehicle, on electrical engineering perspective, it's exactly the same impact as injecting power into a system. So I think the low-hanging fruit right now is working on modulating that charging during a particular, like LOR3, for example, or LOR2. We want to be controlling that load, and EV charging load's inherently really well controllable. It responds faster than a thermal generator. Within a second, we can ramp that vehicle charging load. And then the next question is, should we then export the energy from the battery of the vehicle into the grid? So i.e. going through an inversion, so having an inversion process or inverter to go from the DC, traditionally 400 volt DC bus on a vehicle, inversion going through the distribution network and exporting up, like what we are doing with residential batteries. Right, and we're seeing kind of varied levels of success on that, but there are lots of barriers of entry, just in terms of cost of integrating that and doing the distribution connection, certification, and working with distribution networks to do that. So we aren't seeing that ramp up at a high rate globally, but technically, it's all possible. But my kind of view on this is really, firstly, let's control that charging load. That's the low-hanging fruit, and there's zero marginal cost in doing that before we start doing the injecting from a vehicle into the grid.
Yeah, thanks, Joseph. I think the interesting thing for me about having the renewables team and our consumer finance team that works on EVs and house upgrades and behind the meter systems is that drawing that link between those two activities. So the idea that charging your EV or using your home battery at the right time is effectively the same as a generator in terms of the engineering things. So I don't think the message has sunk into businesses or homes yet that allowing the use of your home load, your panels, your battery, your EV potentially over time, and changing the way you use the high power equipment within your house, responding to grid conditions or price signals, I suppose, is a really responsible thing to do from the environmental perspective. You may not see it immediately on your power bill because of the retail rates. You may not see it as a company in your kind of net zero journey because it's not captured that demand response for the really 4 to 5 hours in the year where you're towards LOR3 territory. It's not well understood that it's a socially responsible thing to be able to control your load. And when I look, for example, at when I charge my iPhone in the evenings, if I plug it in before I go to bed, it says, your charging will be optimized and it'll be fully charged by 5:30 in the morning. So I already hand over power of charging for my iPhone in the evenings. I think you're right. There needs to be a signal to facilitate consumer behavior on that front as well for charging much bigger kits like EVs. Yeah,
and just look at one final comment on that one. I mean, yeah, in terms of EV charging, so on the Tesla, we do a delayed charging because we know it's better actually for an EV to charge just before you need it, so the battery's warm and efficient before you go. So we do a delayed charging called scheduled departure. But we're seeing globally, customer demand is stubbornly inelastic to price signals, and that's nothing new, but that's something which as a market and as an industry we kind of need to tackle as we move forward.
Yeah, agree. I'm just looking at some of the other questions. I guess one interesting one that came up, and the three of you have been in the industry for decades, right? And so one question was, what parallels can you see from the battery journey over the last, say, 5 years that you might have observed or got lessons from over the longer lifespan of the wind and solar industry? So say in the last 2 decades we've had wind, 1 decade solar, and 5 years storage. Do you think there's parallels between the way those industries have evolved?
Look, I'll jump in first, Nick, and I know you've got definitely some thoughts on this one, but my background was in the wind industry, so before I got into the battery storage. And in the wind industry, late 2000s, early through to 2015, there was a rapid reduction in the cost of wind energy, which was driven by the technology, predominantly by increasing rotor diameter. So increasing rotor diameter, and on wind, there's a square relationship between the rotor diameter and how much energy produced, and that drove down the cost of wind energy. And that's where we saw really that the wind industry really picked up in Australia and globally through that technical innovation. And nowadays we're seeing rotors at 200 meters plus, right? We see the same thing with lithium ion. We're seeing that rapid commercialization at the price point, just because of global supply chains being engaged, and the scaling has driven down that cost point, which is a function of both the stationary storage market, but also the EV market. As innovation goes through, supply chains are building up and optimizations are coming through. And that's what's really, that's why we're also seeing the EV market rapidly increasing as well. So I've definitely seen those parallels driven by the technical innovation. And my background not in solar, but I'm sure that there's parallels through there as well.
Yeah, I would just echo some of those things that Joseph was saying. I think from my perspective, probably one thing that seems to be history repeating itself is really around suppliers, and then the robustness of the suppliers. And as per wind, and solar to some extent. Some OEMs go broke. Some EPCs struggle. All of those things are kind of still ongoing with storage. And I think really you can see the maturity of various suppliers increasing over time in battery storage, coming from quite an immature place as well over time. And then probably the other one, which I'm sure everyone is keen to talk about more, that Joseph mentioned, is really the technology adoption rate of lithium. I think Joseph's analogy of wind and the size of the rotor is a good one. I think what people don't necessarily realise with lithium chemistry, even in the form factors that we're talking about now, is it's only really, it's still on a very steep curve in terms of energy density getting better all the time, durability getting better, degradation getting better. It's not plateauing out. We're still on a very, very fast part of that LFP or lithium cell journey at the moment. So yeah, that's probably a slight difference potentially to sort of the learnings out of wind and solar, which have got a very nice continuous rate of improvement, whereas the lithium cells and the battery packaging itself is really accelerating now, and I think it's going to keep accelerating probably for the next 5 or 6 years.
I think for me, the parallels that I see, I alluded to earlier. Sometimes you have the early movers who are reported to be making very good profits, and then suddenly you have a stream of developers trying to get in on the action and thinking that that's still going to be available. It's the market's relatively small in terms of FCAS revenue, and it can easily collapse with significant new build, and so that would be my concern in the coming years. I think many of us had expected that at some point the FCAS market would flatten from where they were in the past few years, and so it's just a matter of time for if you're trying to get high teen returns now on the basis of a fully merchant battery, then that's probably going to be illusory.
Thanks, Tony. So I think I might close with one question to the panel in comments. So I think it was Nick that said that the only thing we know about forecasts is they're going to be wrong. So I'm going to put us all on the spot, and we can retest in 5 years, because I'm sure we would have got it wrong 5 years ago. But we've heard today that the battery market's moved much more significantly quickly than expected, and have proven some applications that were thought to be only provided by the fossil fuel fleet. I just wanted to ask each of you, do you have a prediction for, if we're standing here in 2030, do you have a personal prediction about what might have happened differently to the way that perhaps the ISP kind of economic scenario might play out, or anything that you want to leave us in your own prediction about the future, and we can check it in 5 years' time? All right.
I can have a go first if you want.
Yeah,
I think it was Joseph actually that had that comment before, so I can't take credit for that. But I think it kind of links to what I was saying before. And people may find this slightly odd or controversial, but my view is that, as I said before, lithium rate of change in terms of its density, its cycling, its packaging, the volume of global manufacturing of lithium-ion cells is all just at the start of the knee point of really going up fast. We kind of think back, we've had lithium cells in Tesla cars for X years and so on, but it really is only now starting to hit its straps. And so my view is that out to 2030 and potentially beyond, it's going to be dominated by lithium cells of various durations. The other thing, just from a technology kind of historical geeky perspective, is if you think about, say, lead acid batteries, for example, they've been going from lab or leaving the lab to death for more than 100 years, 90 to 100 years. In fact, you could argue that they're still not dead, because a lot of cars still have lead acid batteries in them. So that's a 100-year lifespan that we're talking about. And so for people to think that, oh, well, lithium's done because Tesla did stuff 10 years ago for vehicles and therefore it's only got 5 or 10 years left is completely false. Like, lithium chemistry is here for a long time yet, and it will keep getting more economic, and it'll keep getting more energy dense, and you'll keep getting more cycles out of it. So that's, I guess, Monique, it's not necessarily opposing the ISP. It's actually probably just reconfirming that it will be dominated by lithium in the next 5 to 10 years.
Thanks, Nick. Joseph or Tony?
Yeah, I'll venture a prediction that's going to be wrong for sure. but looking at the ISP forecast, I feel like as we progress forward, the forecast capacity requirements for batteries, I think, will increase. I think we'll see that personally. I think we'll see that doubling, and I think that's really going to be driven, in my opinion, that as we retire thermal plant, if we retire a gigawatt of coal, we need to replace that by 3 to 4 gigawatts of renewables, and that's going to have to be matched by storage to absorb that. Because if we're not, there's only so much power we can put into the system. So we're going to see minimum operational demand going to be increasing. I think all the forecasts and the ISU predict that as well. So as that happens, we're going to have to really have a lot more capacity in the market, absorbing that renewables and injecting that when it's required. So I feel like there's going to be a definitely increase in storage. Is it going to be predominantly lithium? Our view is yes, but I don't think there's a silver bullet. I think we need a whole range of technologies, including energy generation as well, to make the name of the future, and the Swiss.
Joseph?
Look, I think similar to what Nick said, I think our view is that there's still a lot of growth left in the lithium market. When we started HPR in 2017, it was probably 10 times bigger than what anyone else had imagined would be possible, and most batteries at the time had a 1 hour duration, similar. Our latest project, Collie 2, which we announced earlier this week, has 4 hours duration, and it's over 1,300 megawatt hours, which is 10 times bigger than HPR again. So I think there's still a lot of growth. The boring stuff that I'm hoping will still have room for improvement is probably things like longer warranty periods, lower degradation. Those are the things that will have the incremental economic benefits. But other than that, not from a technological development, but from a market development, I'm hoping and expecting for a lot more baseload contracts, based on generation assets and storage.
Thanks.
Thanks. Monique, also. Do I have 20 seconds just to answer a couple of questions that were coming through?
Yeah.
I noticed a lot of questions. I just wanted to clarify something that I said before around the OTC markets with respect to the CIS. And regardless of whether it's over the counter or exchange traded, or whether it's an ASX cap or whatever it is, the point that I was trying to make was that the CIS has the flexibility to layer any of those things on top, whether it's over the counter or a bespoke bilateral contract, or whether it's an exchange traded contract, that the CIS really gives you the flexibility to do that. So just wanted to say that to clean up a couple of those questions there.
Thanks. Joseph or Tony, were there any other particular questions that you wanted to address? I know that there's been a huge amount of audience engagement, so I'm really grateful for that, and we will circulate afterwards to this panel those questions which we didn't get around to addressing, because I think it's useful for us to hear what the industry is thinking of when we're thinking about what we present and the information we share later on in our respective roles. But I wanted to end with just a huge thank you to the panelists and also to the CEFC team that helped bring the Green Room together, and thanks also to the audience for your interest and clear passion for the topic. You will be emailed a webinar link to the recording. So if you have any colleagues who couldn't attend, or if there's something that you want to rewind and hold us to in 5 years' time when the predictions come true or not, then please feel free to do that. And a reminder just to please complete the survey, which will appear on your screen shortly if you hang on for a few seconds. I've personally found the conversation really interesting. I'm very grateful for the time of the panelists, and I hope you've all learned something today. Thanks again, and over and out from us. Thank you.